to everyone who's joined us, as is the norm with webinars. Let's wait just a few dozen seconds to allow people to come in through the waiting room. But thank you for joining us to the impressively large numbers from all over the world who've signed up. I'll introduce myself. I am Stuart MacDonald, and I am moderating this. This is the latest in the series of thought leadership educational webinars put on by Aero Capital. Aero are now quite well established leaders in the digital investment space, focusing on DLT and blockchain related technologies and crypto assets, including cryptocurrencies, and the tremendous developments that are taking place in that broad space. And specifically, they're focusing on the immense investment opportunities that have been arising, not just in the cryptocurrency sphere, but also more broadly in the DLT space. And these educational webinars are designed specifically for investment professionals to learn more about this exciting, incredibly fast-growing, fast-maturing space, still often misunderstood. And there really are the most exciting investment opportunities within it. And we're getting serious interest from serious investors, whether it be Fidelity or Paul Tudor Jones and Brevin Howard, or Bank of New York Mellon coming in. And Aero Capital is the first player, to my knowledge, to enter this space with a truly and authentically institutional quality multi-manager approach. And this approach is very research driven. And this is reflected in Aero's use of advisors like Giovanni Ricco, associate professor from the Department of Economics at Warwick University. And Giovanni will be our first speaker. Our theme today is the future of digital money and its role in the fourth industrial revolution. I should make clear that Giovanni will need to read or show you a disclaimer in the context of his current secondment to the European Central Bank. And we should make it clear that Giovanni is participating in this webinar as a good friend of Aero rather than as part of a commercial transaction. Once Giovanni has approached our theme from his particular angle, we'll take some questions, and please use the chat facility in order to get questions to us. And then we'll move on to Johannes Gugl, with whom many of you will be familiar from previous webinars. He's a partner at Aero Capital itself. Giovanni, if you're ready, take it away.
Yes, I am. Thank you. And yes, there's a disclaimer here, and whatever I will be saying from now on is just my own view and should not be regarded as the view of the ECB or the Euro system. And I'm obliged to say that because at the moment I'm seconded to the European Central Bank. But that said, it's a real pleasure to get the chance to talk with you, Stuart, and with Johannes about the future of money, and with all of the participants today. And that's a topic I find of great importance. And in fact, I think it's at this point an accepted argument that the two most common forms of money today, cash and bank deposit, will face in the future, and already may be facing, intense competition from different types of electronic currency, or what we call cryptocurrencies, and could become in the coming future obsolete. So to start today, our little sort of walk through the future of the possible futures of money, and in particular digital money, probably it's worth asking ourselves or reminding ourselves what is money. Now, as we all know, traditionally money has been defined as an asset that acts as a unit of account, first of all, as a store of value, and then as a universal medium of exchange. And all of these three functions that are important in defining what is money from what is not money have emerged in response to different economic frictions, if we want to say so. Unit accounts in order to track the relative prices of multiple differentiated goods in the economy, store of value to coordinate and commit actors to future transfers of value, and medium of exchange to respond to the problem of the double coincidence of wants in the barter economy. Now, as we know, more and more we think of new forms of money, as for example, the Bitcoin. Now, this is just chart about the market cap yesterday, I think, of the Bitcoin. Is an extraordinary chart showing the explosion both in prices and in market cap of this asset. So the natural question, given the story and the history of Bitcoin, is whether Bitcoin is money. And in fact, it's only just 10 years since the creation of Bitcoins, and Bitcoin and cryptocurrency have made a huge leap from a niche concept to a reality of relevance to consumers, investors, and also policymakers, I should say. So how does Bitcoin fare against this criteria? Well, in terms of unit of account, we have to say that there is low acceptance in the wider economy, so probably not so well at the moment. As store of value, there's been intense discussion, but it's quite apparent, I would say, that the high volatility of Bitcoin does not provide Bitcoin with a strong sort of function of a stable store of value. And as a medium exchange, well, again, there's low acceptance, but perhaps we can say that there are transactions in Bitcoins in what appear to be specialized markets. So probably the bottom line would be, well, so far Bitcoin is not yet a form of money, but how about more generally cryptocurrencies? So, and in order to try and answer this question, it's important to think about what are cryptocurrencies, how can we broadly define them in economic terms, and how do they compare with other more, I shall say, traditional form of money. Now, if we look at, for example, the definitions proposed by the BIS Committee on Payments and Market Infrastructures, there are three qualifiers of what are cryptocurrencies. So first of all, these are assets that are not the liability of anyone. Second, they are electronic, and third, they are peer-to-peer. And this will compose essentially the three circles here on the left of my slide, and at the center of them, at the intersection of these three circles, would sit cryptocurrencies. Now, if you think about commodity money, well, in that case, that would be clearly a form of a money that is not the liability of anyone, and is peer-to-peer, but clearly not electronic. While conversely, bank deposits are a liability to banks and are electronic, but they're not peer-to-peer. And we can also have a quick look at the right-hand side and compare in terms of properties other forms, more common forms of money like cash or digital reserves or a bank account. And we can have from these slides, I think, a very clear picture of what is the novelty and the interest in cryptocurrencies as compared to more traditional forms of money. Now, if you had even a cursory look to discussions on internet and on blogs, you see that often Bitcoins are compared or thought to be as an Austrian form of money. And this goes back to the essay of Hayek on the denationalization of money. And the idea that Hayek was proposing in that essay was that governments should lose their monopoly of money because essentially they are too prone to mismanagement of currencies and to inflationary behavior. And instead, some market for private money should be created so that different issues and different monies could compete in order to be unit accounts and store of value. And around these ideas, there are different sort of ideas that are articulated sometimes. So the core is that Bitcoin and some other forms of cryptocurrencies. And here I'm really being broad brush because I would like to have a broad picture of what is happening around us. Is that Bitcoins live on a predetermined fixed supply curve. And in fact, as we know, the money supply is capped to 21 million Bitcoin. And therefore, they are often compared to a form of hard currencies. To fixed ideas, they are compared to the old sort of gold standard, where all currencies were linked to the supply of gold. Clearly, here the supply curve is even more rigid than gold because it's not sensitive to changes to prices of the Bitcoin, as instead gold mining is. And also the idea that cryptocurrencies might bring an end to a fractional reserve of banking, and sometimes people think that this has a stabilizing effect of the economy. They think of that as a source of business cycle fluctuations, and also they could bring an end to the monopoly of central banks on the issuance of money. However, modern economic thinking points to fundamental issues to this vision. So first of all, money, as we saw in the last recession and during the global pandemic today, is an important tool of macroeconomic stabilization. So the supply of money has to be adjusted in order to respond, accommodate shocks, in order to minimize business cycle risks to the economy. But also the unit of account as a role of a currency has strong network externalities. So consumers and investors tend to coordinate along unit of accounts. So monopoly can emerge. And finally, historically, we know that private monies are fragile and they all sort of predicated on trust, and sometimes trust can evaporate quickly. Now, let me make one step further and to expand, let's say, the landscape view we are having on what is money to this slightly broader point of view, the money tree, and a possible classification, a possible taxonomy of monies, and all of the emerging forms of money comes through the intersection of different criteria. First of all, the type, either a claim of an asset or as an object, either electronic object or a concrete one. And the second sort of parameter will be the value, whether there is a fixed value or a floating value against some assets. Third, the form of backstop to this asset, whether it's centralized by government or by private, or there is no backstop. And finally, technology, whether it's centralized or a decentralized, perhaps in the form of a DLT technology. Now, if you go through these three, at the bottom you find on the right the forms of money we're describing so far: cryptocurrencies and central bank money. And on the left you find what is defined as B-money, E-money, and I-money. Now, B-money is the most common claim-based money existent, and essentially you can think of that as bank deposits. E-money is the emerging form of cryptocurrencies that issue claims that they can be redeemed in a currency at face value upon demand. There are different forms. I mean, these charts mention some of them. And finally, I-money is potentially the new means of payment and is essentially very similar to E-money. However, it offers a variable value redemption into a currency. So it's more like an equity instrument. Now, if you think about the proposal of a Libra that now has changed name, as I will discuss in a second, will fit in that category. But the main point I want to make is that when you look at the left side of this chart, on the claim side, you see that under the umbrella of E-money and I-money, there's lots of movement and lots of interesting things are happening. And in fact, there's one in particular that is important, and are stable coins that are a huge sort of center of attention from policymakers, from different types of investors, different types of big tech companies. Now, what are stable coins? Well, stable coins, in a very short definition, are private electronic currency that are created to address some of the issues faced by other cryptocurrencies, in particular the high price volatility, but also the limited scalability, I would say. Now, all of these stable coins are defined by the stabilization mechanism at the core, because the idea is to anchor the value of these stable coins to some either low volatility reference fiat currency or some asset or some basket of currencies or assets. In particular, we can define 4 types of stable coins backed by funds, liquid funds, backed by other traditional assets, the so-called off-chain stable coins, and backed by crypto assets or on-chain collateralized stable coins. These 3 forms are centralized stable coins. They have big tech managing them. The last form is backed by user expectations. So there's no underlying asset and they are decentralized. Now, at the top of this sort of list live essentially the big players. And in fact, if again you allow me to expand once more our landscape into the even bigger world of retail payment and payment infrastructure, you see that these stable coins can fit into a diagram in which we have on the left the type of payment infrastructure, where it's an overlay over a more fundamental infrastructure. It's a standalone independent structure, while on the top side of this diagram, you have the reach, where it's domestic or global. And when you go to standalone and global, you have projects like Libra that are huge projects with potentially global impact. And in fact, those are what we call global stable coins. Now, why they matter? Well, because if you just try and gauge, as for example was done in a by the ECB, from which I'm borrowing this chart, the potential size of the Libra reserves as relative to the largest money market funds in Europe, you see that under different scenarios, Libra would dwarf money market funds, would be a huge player. So what are the implications of that? Well, there are lots of implications. One of them, an important one, is what happens when there are risks in the system, and who ultimately will bear the investment risks into these objects. Now, if the stablecoin arrangement does not guarantee a fixed value to the currency, let's say, then it's equivalent to a fund share. And therefore, the ultimate bearer of the valuation risk is whoever participate to the share of the fund, the investor or the consumer. Conversely, if the stablecoin arrangement guarantees a fixed value, then the issuer will be the ultimate bearer of the risk. In both cases, it's clear that on this magnitude, there are important liquidity risks, risks of contagion, and global stability risks for the wider economy. But what is interesting here is that beyond the risks, there is also potentially the emergence of a different sort of financial structure, financial architecture. And in fact, if you think about the traditional financial system, that system revolves around intermediary institutions, banks and commercial banks, investment funds, amongst others. Now, the role of this institution is traditionally to collect and pool savings from consumers and direct them via lending to borrowers, to investment opportunities. In doing this, of course, there's a centralization of this operation of, if you want, maturity and risk transformation, and of convenience redenomination. Now, the world in which we could be moving onto with the emergence of global stable coins around a big tech company and based on two electronic platforms is a different world in which decentralization, or decentralization first and then recentralization and disintermediation happen. And a new system emerged around these payment platforms that essentially might have different financial activities around the payment platform, such as, let's say, lending or asset management or banking, and could intermediate essentially between different customers, both the activity of payments as a core structure and traditional activities of the financial sector, but could also essentially have as an important part of their business model data management and even social connection activities. So in a way, these platforms supported and promoted by promoting digital currencies have the potential to reshape the financial system by reorganizing all of the financial activities we know around the central payment platforms functionalities, while all of the other sort of financial services such as credit insurance and banking would be subordinate to the platform and payments services. So I'm going towards the end of my very brief discussion. And as you can see, I have just the time to touch upon very important questions. But where we are essentially brought to think at this point is whether in the future these new emerging forms of money, of currency, of financial platforms or payment platforms will bring to the fore what we can think of and has been defined by Marcus Brunemeyer at Princeton as a great unbundling. And the idea is that while in the traditional sort of currency markets, let's say, there were strong frictions that were making network externalities and therefore the switching between one currency and the other complex and difficult, this new form of electronic and digital currencies and cryptocurrencies make the switching and coexistence of different private and possibly public form of money at the same time much easier. And this might bring a world in which the traditional function of money as store of value, medium of exchange, and unit accounts are unbundled, and therefore different companies, different form of monies will compete in order to rebundle some of this function of the money along with other new functions, as for example data gathering, social networking services, lending services, onto payment platforms and electronic and digital currencies of new form. What is the potential issue with that? Well, there are lots of risks, of course. So first of all, the emergence of non-geographical currency areas in which essentially consumers and investors live and trade in segregated currency areas that span across countries and continents, but also the potential dollarization and loss of sovereignty of the central banks, of the governments, that will also entail a loss of macroeconomic stabilization tools, but also systemic risks when this global platform should fail, and of course important privacy risks for consumers and investors once all of the information is centralized. So the last two things I want to say, if I have still 1 or 2 minutes, is whether this brings in another dimension to the discussion on whether there should be some sort of thinking about whether money is a public good, either in the form of government money or in a form of a decentralized arrangement that is not fully privatized and appropriated by giant platforms, and in which sense money is a public good. Now, economists define public goods as a particular set of goods that fulfill 2 criteria: non-excludability in its provisions and non-rivalry in its consumption. It means that nobody can be prevented from enjoying the goods, and also that one person enjoying the good does not limit the ability of another one enjoying the same good at the same time. And we have examples of public goods as clean air, national security, public lighting, many of them. Now, of course, money does fail on these two criteria, because if I use my money, you will be not being able to use the same money too. However, some of the properties of a monetary systems are public goods. And these are, for example, the stability, the uniformity, and the interchangeability of the money system that allows smooth transaction and easy transaction inside the currency area. So this leads to the last sort of set of slides, and this is more of a provocation of thoughts rather than a complete detailed discussion of each of these topic. And the last thing I want to mention is central bank digital currencies, because they seem to be on the near horizon at this point. And the idea that in order to preserve, at least to some extent, the public nature of money in some sense, central banks should engage into the creation of purely digital forms of money. Now, we know that there exists a form of digital money on the central banks. These are reserves, but they're not for all. They are reserves for the banks. Now, the idea of a central bank digital currency in one word will be reserves for all. However, two forms of central bank digital currencies are possible: retail central bank digital currencies, that is a consumer-facing payment instrument, perhaps intermediated by a layer of private actors, and the wholesale CBDC, that is a restricted access digital settlement instrument for wholesale payment applications. Now, of course, the emergence of crypto assets and stable coins poses a challenge to the role of central banks, as I was trying to argue before, and a challenge to the role of national currencies themselves. The idea, discussions around central bank digital currencies are an attempt to address these questions, these issues, by envisaging the creation, at least, of some form of central bank digital reserve that is in some form universally available. There are questions there. One of them is, again, privacy, of course, and there's a debate to be had on how these forms are, these sort of potential risks are managed. But also there are important questions about the architecture of these objects, whether it should be decentralized and peer-to-peer, maybe using DLT technology or not. And of course, different futures are possible. And this brings me to the last slide, that is what was on the Financial Times today, the emerging digital currency of China, that is not decentralized, is not, as I understand, based on a libertarian idea of a digital currency that stems from the original sort of Nakamoto approach, is a very centralized currency that has intrinsically embedded risks about control and privacy. And on this, I shall stop. Thank you.
Hey, that's terrific. Giovanni, thank you. The great frustration with all of our webinars, with Era Capital's webinars, is that we get more questions than we're going to have time to address directly during the webinar itself. So I'd very much encourage anyone who's on this webinar to get in touch with Arrow with any questions that they'd like to go into in more detail than we can cover today. To give you some idea of the questions that we've received, one comes from Saksham Diwan. Going back to the denationalization of money by Hayek, I think he claims that money is no different from other commodities, i.e. better supplied by competition between price issuers. Is this something you agree with, and something you think applies to cryptocurrencies in general? And Giovanni, I'll give you a couple more of them, and maybe just address one in the time that we have. Another is, could you tell us about the current regulatory standing on central bank digital currencies and stable coins? For example, the differences between the US, Europe, and Asia. Another question is there a chance that cryptocurrencies could, like the gold standard, speed adjustments in the real economy, but also exacerbate instability? These are just some of the questions that have been put. I wonder if you'd like to take on any one of those.
So thanks a lot, Stuart, for summarizing these fantastic questions. And I think the first and the last probably go in the same direction. Is money just another commodity that could be traded in a competitive market, or there are externalities? And that's the topic of the third question. And my take on that is that it's not a commodity like any other, and there are huge externalities. And this talks about the role of money as a tool of macroeconomic stabilization. Now, we have seen the action taken by central banks during the last financial crisis to steady the financial system and to steady the economy, and was followed what has happened following the huge sort of economic crisis triggered by the pandemic. Can have no doubt that money is a tool of macroeconomic stabilization, and the central bank adjusts its policy stance and therefore has to modify implicitly, if you want, the money supply in some sense by moving prices effectively in order to perform that role. And clearly a problem with cryptos with a very inelastic supply is that all macroeconomic shocks have to be reflected in adjustment in price and quantities in the economy. And this could be, especially in the presence of high volatility, could be detrimental for the welfare of the economy. And clearly there's a loss of tools in adjusting and in defending the economy against business cycle risks. And on the second question, very briefly, I think the landscape of regulation is fast evolving in US, Europe, and Asia. So it's probably not worth to take a snapshot at today, but rather perhaps look at the long-term sort of line of adjustment in the regulation. And I think there is an effort in making space for a balanced sort of path by which essentially new innovations can transform deeply the financial system without destabilizing in the short run the economy and the financial system itself. But that's my very personal opinion again.
This is really, really good. We'll simply invite you to come back to another of the Era Capital webinars in future. This is fascinating, and thank you for being such a good friend to the company, Giovanni. Till the next time. Now, thanks for being so thoughtful with your talk. We're going to move now to Johannes Gugl, partner at Era Capital. And just while we do so, I'll just share with you, my experience of this whole space. I used to think, like many, that blockchain is just a database and that crypto is a slice of the Wild West, full of whales and incandescent teenagers. Now, as the space matures, institutional investors are coming in at a great pace. Trading infrastructure is coming together, and if anyone wants to take advantage of the immense investment opportunities that are there in that space while controlling the risk and also grabbing the diversification benefits that it offers, you could perhaps consider an institutional quality approach to this, and this is where Era Capital's own approach is interesting. Now over to you, Johannes, and again, please feed questions into the chat, and over to you, Johannes.
Yeah, thanks, Stuart. Thanks also, Giovanni, for those exciting insights. As we brought the last times more about like the investment perspective of DLT and crypto assets, this time we also bring more a little bit about the practical aspect of all of that, and there with also like in our title, the fourth industrial revolution and digital money and its role in that. So first of all, I want to start a little bit with what is the fourth industrial revolution. So the fourth industrial revolution came up with the World Economic Forum and with Klaus Schwab, like the founder, who wrote a book, I think around 2016, which described really those moves, like as you see, like from industry 1.0, really the start of the industrialization with steam power, water power, where much more throughput was also possible with that, and also with much more power behind that. And the second wave with the industrialization through like the introduction of assembly lines, and especially like with the electrification also of the industry. And third one was one which like kind of all of us experienced, really the industrialization in terms of like automation, robotics, and single piece flow productions, etc. And what is Industry 4.0 really? It's a combination of many new innovations which came up in the last couple of years, which I get into in the next slide a little bit later. Overall, like this innovation or this cycles were always driven by innovation and constantly improved the output through increased throughput, and especially also elimination of waste and the increasing of asset efficiency. So with in Industry 4.0, what maybe also came a little bit short in 2016, the fourth industrial revolution by Klaus Schwab, is really that role of the blockchain technology and also of digital money or cryptocurrencies in that, as it can or will even like act as the backbone system for a self-steering value chain network, I would say. So, which technical innovations driving really the Industry 4.0? So we have different views on that. So when you look on the top level, it's more like the integration of vertical and horizontal value chains through cloud computing, mobile devices, IoT platforms. And then we have also the digitalization of business models and customer access, also through location detection technologies, big data analytics, authentication of fraud detection, 3D printing, especially like in like after parts market, also very important. And then also the digitalization of products and service offerings through smart sensors, advanced human-machine interfaces, multi-level customer interaction and customer profiling, and also like topics like augmented reality. So you have to think that like in the future, really all those components will play a crucial act also like in value chain of Industry 4.0. So, but we will bring that a little bit more into context. But when we're talking about industry or fourth industrial revolution, we have to see it also in the broader context, not only in the industry context, but also in terms of like smart solutions, which come up also with more sensors, more smarter solution, artificial intelligence, also with smarter products, what we have, learning products which are really customized to the needs of the clients. And this is also something of the fourth industrial revolution, to really personalize also products and services more and more. With that comes clearly the smart supply chain, smart factory, and also smart cities. And you see also like here the technology enabler. It's not like that's like fixed technology enabler. I think it's a compilation of all those different innovation, different technologies and new approaches also, which really form that. But we will go a little bit deeper into that. So what is the impact it especially has on a supply chain? And there would also like comparing a traditional supply chain with the Industry 4.0 model. And when we're looking at such a traditional supply chain model over the like 90s, 2000s, like standard models like the SCORE, the supply chain operating reference model, became popular. Also already like combining really a whole holistic view on a company's supply chain with the the suppliers also in eyes, and even like the supplier of the suppliers there, and the customer of the customer. So connecting really the whole holistic supply chain together, but still with the silos. What we still have. I mean, like that's still the reality. What we have. It's not so easy, like even connecting existing ERP systems together with different APIs, etc., make them more intelligent, especially like for sales and operations planning. That's still a tricky thing with those silos what we currently have. So the Industry 4.0 model is really a very different model to that. So you can understand it as a model which really takes like a component of the supply chain, which doesn't really has to be in one silo, in one company. So we know that from the traditional industry that there are often like extended benches integrated also, which often lead to efficiency, like higher inventories, and overall a longer throughput time. But by integrating these services in a smart way, like that can start really from the product development, which like an external product development company can be in charge of, what we often have in the industry, like how they're transferring the data, how they're validating the data during the development process already, and how that goes also already in the material planning and in procurement, in getting the data in the system already for the further planning into that, and then really the production planning ramp up, also all the data is what you have included here. So and that goes really further than along the supply chain with, as I mentioned before already, like extended workbenches, external processes, as we see like complex products, which have different vertical integration levels, and really a system having in place then which smartly can steer and the process and trigger one next process by the prior process, for example. So this is really where the blockchain comes in now, as you see here with the yellow blocks in. So this is the role really what the blockchain has here, which is so important in that with the smart contracts behind that, the whole value chain can be triggered by the smart contract. So when an event really happened, that it triggers another future process, which can be a planning process, which can be a direct like transport process, etc. And also the blockchain as such really acting as a secure data exchange. This is also like all this data security what we have with the blockchain technology, that you can really only provide secure access to that, and especially when you build that on more like a private blockchain based, like it's often also the case then with a private permission blockchain for corporate uses. Then you have like for sure then out of that the whole data and system integration already. Then you have like really the automated order processing, what you can steer, the supply chain simulation and planning, the quality tracking, what you can directly do. So quality management is also an Industry 4.0, a very important part where you even can track in the parts, see like, okay, from the supplier and the supplier already. So what raw material was, which batch it really was. So you can track that much better, or as we have it currently also with all the vaccine distribution, where you need also to track the temperature, so the cooling, that the cooling chain is not affected, and also like you have that in fast moving consumer goods, where it's also very important that you really have a secured cooling chain there. So the tracking of the supply chain, that's like a clear advantage also with the blockchain technology. And for sure, in all the automated payment what you have. So as you see that it really has like different kind of like microservices which form then together a value chain. All those services which are executed are also linked with clearly with the price. And as soon as like the service is either executed or the product is developed, it can automatically trigger also a payment process. And this is also then becomes interesting when this payment process can be triggered even like with own tokens, what we see then also in the use cases where this can be faster transmitted, and also improved in the cash-to-cash cycle behind that. So this was Industry 4.0, but also like in smart cities, as we're talking about the fourth industrial revolution, smart cities, that's like a concept that UN works, a lot of working groups working on that, and a lot of companies also, like the Siemens and Bosch in the world, looking at how can we make cities smarter, how we can make them more sustainable. And there's also the blockchain becomes a very, very strong role into that, as it can trigger then with smart contracts behind that, that if conditions are met, that certain triggers are executed again. That can start with smart lights, you know, like that not always the streets have to be lightened, so to save also energy behind that. Smart meters, which can take different data from different sensors also out of that. Smart parking, there are a lot of interesting startups or apps out which help already in smart parking. Weather sensors, which also can adjust then different setups in the in terms of like if it's raining or if the sun is shining, can also then in combination with solar panels, solar inverters behind that. But also digital signages, for example, is very important also for traffic systems, for example. And also traffic systems can really be improved. Think about it, if cars also deliver signals to a blockchain and can also already simulate how the traffic will look like in like a couple of minutes, and adjust really the traffic light to reduce the fuel consumption, for example, also by cars, and make also cars then more sustainable. Or like with the electric cars, then it's anyway a different story. But yeah, electric vehicle charging behind that, IP cameras, which can also detect, can steer something. And for sure, also waste management, you know, like for example, the waste truck don't have to drive all the way when the waste is not really, the garbage boxes are not full. So only then when it receives a signal that they are full, then they are driving there, not just like in their normal route. So you see there's a lot of like intelligence behind that, and the blockchain really enables that. And with those services, which also often have a price tag on it, as services are used, like in the sense of a pay-per-use, then transactions can really be executed also directly to those objects. And there you also have to see that when we're talking about the fourth industrial revolution, we're talking about like the allocation of resources in terms of like human resources, but also of technical resources, which all have then a potential price tag behind that. So what is really then the enabler for the fourth industrial revolution? So when we look at the role of the distributed ledger technology, number one, as I explained, it's really full programmable business logic behind, which can steer a whole value chain, as I would name it. Then the automatic order, process trigger out of the smart contracts, the single source of truth, what you have with this data repository in the blockchain, the security through the cryptographic securitization behind that. And what is also very important part is really the network participation. I come to it in a minute, staking, and the whole rewards management in such a value chain. The role of digital money in that is also, as we clearly can see, is the means of payment of such like micro, also bigger transactions, the pay-per-use model, what you can attach to that, automatic settlement, automatically included with that, but also like factoring, for example, is an interesting part, as more and more such factoring solutions came up in the past, in like more in the traditional world, but like by lending out, for example, buying bills and pay the company earlier to improve the cash-to-cash cycle, and charging like a percentage or something like that. It could be also like an interesting model in the future. And staking as such, I come to that in a minute, and but also digital money, as Giovanni also before touched a little bit, it can also be for companies used for hedging, you know, if it's like combined cryptocurrencies. So as you see, like companies often have different currencies, euros, dollars, yens, etc. They have to manage in their accounts and also see and balance into that. So yeah, huge potentials in that space for digital money. So now we want to look a little bit into use cases. I think all of us who are a little bit into the whole crypto world know that there are a lot of use cases, and especially Industry 4.0 or the fourth industrial revolution, bringing a lot of those forward. Also, as we can see, like from the currency exchange, that's clear. But in terms of like trading, we see like really examples of commodity trades, which are highly complex with a lot of parties, like with shipments, with insurance, with warehouses, and those often like changing their owners during even the shipment, for example. So all the contracts and everything like that have to be moved over to another party, which is a huge work in traditional work with smart contracts behind, and really interesting value chain there. That can be like with a click on an app and a signature on the other side. That can happen. But let's dive into two very interesting examples or use cases. Maybe a lot of you are already familiar with IOTA. IOTA is like kind of already like a long-term star in the crypto world, has been long under the top 10. I think it's now 22, Berlin-based company, which early pioneered in the area of Internet of Things. And that in the combination with the distributed ledger technology. So they invented that whole system with a blockchain or with a DLT based backbone system with IoT sensors, which have smart contracts in the background and which can directly then form kind of network of different resources, which can be interconnected then together. So as you can see also here, IOTA is an open source distributed ledger in cryptocurrency designed for the Internet of Things. What IOTA has especially developed is an industry marketplace that enables the autonomous trading for humans and machines. And it provides trusted, scalable, secure, and vendor-neutral platform for all industry to increase automation, reduce costs, and optimize workflows. So it's really interesting also when you go into that use case that you can really connect to this industry marketplace. You can connect machines with that. You receive then your own wallet for your machine. So it could be that you have like a drilling machine somewhere, like you have like some kind of asset, what can be taken into a value chain, and you can directly connect it and get even like really orders out of that, and production planning behind that also. What is really interesting is that also this token is used for to like get access into the system, but also get paid into the system. And with the increasing value of this IOTA token, then it's also interesting then to keep it and hold it as also as an asset in your pocket. So that's a very interesting use case with IOTA. Another very interesting use case is currently also very much in the news is Fetch.io. Fetch.io is a Cambridge-based AI intelligence lab, and they are building really like a decentralized machine learning platform. So they have introduced like kind of like agents which can be trained in their functionalities, and also with the backbone of a decentralized ledger technology behind that. And that's also interesting is that especially Fetch.io uses also a proof of stake mechanism. If you know the difference, like in a proof of work mechanism, you have with the miners, the proof of stake. We have the stakers, which have staked their assets, their tokens, to make the consensus algorithm possible, and especially also then working as a validator. So such a network works from the validators, which are kind of the miners, that this is always needed in the proof of stake. In DeFi space, we see that a lot already with staking on exchanges, but also on protocols, etc. And this staking is a very interesting topic of the future. If you see it like as as a notary, as a like global notary system also, which confirms all the transactions, checks it, are the data that correct, is the hatching algorithm correct, etc. That works as this validator network, and every participant can really act as or participate in that network by staking their coins there and getting rewarded out of that. So currently the APY of those reports, if you're buying the fetch token, beside that the fetch token increased, I think, by 300% in the last couple of months, that you can stake this token and generate a passive income out of that. So this is the really exciting thing also about the whole DLT world, that it's not like this concentrated silo world anymore, but it gives really, it is a decentralized autonomous organization or world even, where everyone can participate in such a network. You can, as you see, you can add a machine, like a resource or your own knowledge, your own capabilities in such a value chain and contribute and being rewarded, or you providing money to them with your tokens for the validator consensus, or even like providing it as a liquidity and get also rewarded for that you're providing liquidity to the company, improving their cash flow, their cash-to-cash cycle, etc. So this is really exciting. Maybe for some, it's not so easy to grasp now, but we are on the way. Like Fetch AI, for example, they're working with Festo in Germany. Festo is one of the most innovative like production system development company on the world. I know them by myself pretty well from my past. They're really, really highly innovative. They're working with the top manufacturers in the world, delivering, making really research work also out of that. So we will see in the next 5-10 years, we will see that coming really to a reality. So what are the key takeaways out of that? So the distributed ledger technology plays really a vital role as the backbone for the application and the interconnectivity of the future networks. DLT and smart contracts represent programmable business logic steered by input variables and confirmed by the consensus algorithm. Digital money or tokens allow instant settlement between the parties and improves the cash-to-cash cycle. Digital tokens can be sold or rewarded to stakeholder, reflecting a real-world asset due to its utility function and reward systems. And similar as in the DeFi space, the proof-of-stake consensus algorithm requires the validators staking their tokens, and they will provide a massive income model for the broad mass or even for professional investors. So we will also see that in the future potentially. Staking could even be used for currency hedging or treasury management. And the future will be decentralized and involves a network of stakeholders and contributors instead of a siloed and closed value chain. So thank you for listening. And
Johannes, that was beautiful. Really, really interesting. We've had a lot of questions. We don't have time to really address them, except one that I'll put to you, just to give you some idea of the scope. One is about how, going back to the IOTA page, how does such a token increase in value? Another is, how does the blockchain connect all these components of Industry 4.0? Another one, how interconnected is DLT blockchain with AI? Another, is there a high degree of correlation, and do both DLT and blockchain technologies complement each other? Perhaps the one question that you can answer in the couple minutes remaining to us, Johannes, and I would encourage all of you out there whose questions are unanswered or who wish to find out more to get in contact with Arrow Capital, because as you can see, they pretty much know what they're doing. At least I think so. Let's address in the next minute flat, what is the best way to profit from these developments, Johannes?
What is the best way? Yeah, I think really looking out for such projects. If you want to get directly involved into that, look into a project like Fetch AI. I don't want to really make advertising for that, but I'm pretty much fascinated also what they are doing. So I think that's really, really innovative, and contributing really by buying such tokens, staking such tokens, and looking also more and more in that direction. I think there are a lot of other projects also in the pipeline, and yeah, participate like either in such staking, dive into this topic, see also if you can offer something also for the fourth industrial revolution in terms of like participating as one value chain or in this value chain. And I think that's it. And I mean, like investing into the crypto space anyway, because that's what I wanted to show here also, that we're not talking about tokens which have like questionable value or something like that. There is true value behind that, and I think such examples really demonstrate that.
That's terrific. And cryptocurrencies themselves, and there are the opportunities with DeFi. There is such a proliferation of opportunities, some short-term, some long-term, some medium-term, some volatile, some steady. Hence Arrow's investment thesis that a broad, diversified, tightly managed portfolio may well be the best way to avail oneself to take advantage of these opportunities. Thank you to everyone. I would encourage you, be in touch with your Arrow contact to find out more. And till the next time, everyone take care. Thanks again, Giovanni. Thanks, Johannes. And goodbye for the moment to everyone.
Thank you, everyone. Bye-bye.
Bye-bye.
Bye.